We often talk about the economy in these, huge abstract terms. Interest rates, tech valuations, geopolitical shifts.
Right, the big picture stuff.
Exactly. But if you really want to check the pulse of the American household in 2026, you don't look at the NASDAQ. You look under the kitchen sink.
Ah, like that.
So today, we are digging into the Clorox company's Q2 fiscal 2026 earnings.
Yeah.
And before you tune out thinking it's just bleach and cat litter,
Mhm.
well, this is a live experiment on pricing, digital transformation, and frankly, the psychology of the consumer.
It's surprisingly messy for a company that's all about sterile surfaces. You've got this massive digital overhaul that's disrupting their entire P&L,
Yeah.
a strategic acquisition of, a pandemic darling, and a very specific bet on what they're calling the bifurcated economy.
That is the word of the day, bifurcated. We're seeing this split screen in consumer data. But okay, let's start with the immediate numbers because Q2 was, well, it was noisy.
Very noisy.
On the surface, they beat revenue expectations, came in at $1.67 billion. But they missed on EPS. That was $1.39 against an expected $1.43. Now, normally a miss like that for a CPG giant gets punished, but the context here is all about this digital transformation.
It is. And we're not just talking about some software patch. This is the culmination of their massive ERP rollout. They're switching to SAP S/4HANA. The final, most critical phase just went live in January.
Which is basically open heart surgery for a company that lives and dies by logistics.
It is. And because they knew the system would be down, or at least unstable, during that cutover, they did something called a shipment pre-build.
Okay, what does that mean in simple terms?
They basically forced retailers, your Walmarts, your Costco's, to just load up on inventory back in January so the shelves wouldn't go empty while Clorox was, turning the servers off and on again.
So that explains the revenue beat. They pulled sales forward. But then, if they sold more, why the EPS miss? Shouldn't more volume mean more efficiency?
Not when that volume is driven by emergency logistics. The friction costs, as they called them, were significant, meaning they were running overtime in the factories, paying for expedited shipping, anything to keep service levels high during the switch. And that hit their gross margins by about 130 basis points.
So they paid a premium just to keep the shelves full.
Management saw it as an insurance policy. Better to take a one-quarter margin hit than to lose shelf space to a competitor because you couldn't ship your product.
It's a calculated risk, I get it, but it makes the guidance tricky. If Q2 was artificially pumped up, then Q3 has to look terrible, right?
That's the unwind.
The retailers are sitting on a mountain of bleach they're not going to reorder.
Exactly. Management was very clear Q3 will see a significant dip as that inventory normalizes. But their argument, and Linda Rendell was really adamant on this, is that the glitch is now a feature. The system is live. The noise is temporary.
And the payoff is coming.
They believe this new digital core will drive margin expansion in Q4 through automation that it wasn't possible for the old system.
I am always skeptical when I hear that the pain of an ERP implementation magically turns into profit the next quarter. There's always a hangover period, right? You're just fixing bugs.
That's a very fair skepticism. But they are projecting a return to mid-40s gross margins pretty quickly.
Yeah.
They seem confident that the new visibility they have into the supply chain will let them cut waste faster than the new system creates headaches.
We will see. I'll believe that in Q4.
Yeah.
But let's pivot to the products, because they're not just fixing the back office, they're launching this innovation blitz. And this ties right back to that bifurcated economy.
It does.
I was looking at the new product slate, and the strategy feels like if we can't sell more stuff, we have to sell better stuff.
That's the classic defensive playbook in a low-volume market. You have to decommoditize your commodity.
Okay, so take the new Pure Allergen platform. For years, cleaning was about dirt or bacteria. Now they're claiming to denature allergens. What is that?
It's a pretty sophisticated pivot. They've identified that allergy sufferers are a high-value group. Right now, if you have severe dust allergies, you're either cleaning constantly, which is work, or you're medicating.
Or both.
Or both. Clorox is introducing a chemical formula that actually modifies the protein structure of the allergen on contact. So it's not just removing it, it's deactivating it.
But is that a mass market play? It sounds niche. For the super sensitive.
It's a premium play. In a K-shaped economy, you have a segment of consumers who are doing fine and are willing to pay a lot more for health outcomes. They won't pay 20% more for a shinier floor, but they might just pay 20% more to stop their kid from sneezing.
It moves the value prop from hygiene to wellness.
That distinction is crucial. Wellness gets a much higher multiple than clean. And they're trying to do the same thing with trash bags, which that feels like a harder sell. The grad force flex with Leak Guard.
I saw that. I admit I kind of rolled my eyes.
You might, but trash juice, as gross as that sounds, is a major consumer pain point.
Oh, I hate it. It's the worst. But in an environment where people feel squeezed, are they really going to pay a premium to avoid a leak? Or will they just double bag the cheap store brand?
Well, the data suggests that peace of mind is sticky.
Yeah.
This is Clorox's bet against private label. A generic trash bag saves you, what, maybe $2?
Yeah, about that.
But if it breaks on the way to the curb, the cost and frustration in cleanup, it's high. Clorox is betting that consumers are risk-averse when it comes to failures in the home. They're selling failure prevention, not plastic bags.
That brings us to the competitive landscape, because the household segment, that's where the bags and cat litter live, was the real weak spot in the report. Volume down, pricing negative.
This is where the brawl is happening, especially in cat litter. The transcript specifically called out aggressive promotions from competitors.
I saw that they mentioned Scoop Away at Costco.
And the Costco factor is huge. If a competitor can lock a customer into a 40-pound bag of litter, that person is off the market for 2-3 months.
It creates a hole in Clorox's sales cycle.
A big one. And their response is interesting. They aren't just slashing sticker prices to match. They're using something called price pack architecture, or PCA.
PPA, that's a term we hear a lot. What does it actually look like on the shelf? Is it just shrinkflation?
Not really. Shrinkflation is about hiding a price hike. PPA is about meeting the consumer where they are. If your data shows a low-income shopper has exactly $10 for litter and your box is $14,
yeah,
you just lost that sale.
to the dollar store, yeah.
So PPA means you engineer a bag size that lets you be profitable at $9.99. It's about accessibility.
So it's segmentation. It's not one size fits all.
Exactly. You've got the huge bulk packs for the value seekers at club stores, and then smaller, very specific price point packs for the cash-strapped shopper. Get the PPA wrong, and you get squeezed out of the aisle.
And that squeeze is what I want to zero in on. We keep hearing about this K-shaped consumer. Usually in that environment, private label store brands, they explode. But Clorox said private label share was only up 0.1 points.
I know, that was the most surprising metric in the whole report.
That's flat. Statistically, that's nothing. So why aren't people trading down?
It suggests the brand moat is deeper than the macro data would have you believe. Even when that low-income consumer is under pressure, they seem to be prioritizing trust in chemical performance. You might buy generic cereal, but you might hesitate to buy generic bleach.
Because the cost of it not working is higher.
It feels higher, right?
Yeah.
It goes back to that risk aversion thesis. But we do have to be careful. The household segment was down, so while they aren't losing to private label, the whole category is under pressure. People are just using less.
Or they're buying that competitor's bulk bag at Costco. Okay, so speaking of expanding, we have to talk about the GOJO acquisition. Clorox is buying the maker of Purell.
A significant move.
My first reaction was, why now? Buying the king of hand sanitizer in 2026 feels like buying a Zoom subscription in 2023. Are they catching a falling knife?
I get that reaction. If you look at it just as a retail play, selling those little bottles at the checkout, it looks like they bought the top. But this isn't a retail play. No, this is a B2B play, a business-to-business play. GOJO absolutely dominates the institutional market. Hospitals, schools, airports.
The dispensers on the wall.
Those dispensers are incredibly sticky contracts. Clorox has a pro business, but it's always been weaker than their consumer side. By buying GOJO, they instantly acquire a massive footprint in professional hygiene.
So the synergy is in the bundle.
Precisely. Now, Clorox can walk into a hospital network and say, we'll handle your surface disinfection with Clorox Pro and your hand hygiene with Purell. It's a total solution. It consolidates vendors for the hospital and locks out competitors for Clorox.
Okay, that makes a lot more sense than just hoping we all start sanitizing our hands like it's 2020 again. It diversifies them away from the grocery shopper.
And it fits that wellness premium strategy. Purell is the gold standard brand for hand safety. It aligns perfectly with Pure Allergen and Leak Guard. It's all about branded protection.
Let's look forward then. Management dropped some numbers for 2027 that really caught my eye. They're calling it a get back.
This is the financial engineering, or maybe the optical illusion of the ERP transition. Because 2026 is so burdened with these one-time costs and the messy shipment timing, the baseline is just artificially low.
So they get to look like geniuses next year just by returning to normal?
That's the narrative. They estimate that in fiscal 27, just by not having an ERP rollout, they'll see a sales lift of 3.5 points and an EPS jump of about 90 cents.
Wait, that's almost $1 of earnings per share just from the absence of pain.
Right. It paints this picture of a company that is basically a coiled spring. The underlying business is performing, but the financials are being suppressed by the surgery of this digital transformation.
Right.
Once the patient heals, the spring releases.
But is that a guarantee? I mean, 3.5 points of sales growth in a pretty stagnant category?
Yep.
That's a lot to promise just from normalization.
It is aggressive. It assumes they stabilize the share losses in litter and trash. It assumes the innovation blitz, the avocado ranch, the allergy sprays. It assumes that actually gets traction.
And it assumes the consumer doesn't get any weaker.
Right. If that K-shape breaks downward, that automatic recovery might just evaporate. It also assumes the ERP system actually delivers the efficiencies they're promising on the back end.
A very big assumption.
It is. But the early indicators, like getting through the January cutover without a major crash, suggest the execution is on track. They're reporting planned downtime, not system failures.
So if we zoom out, you have a company that just rewired its own nervous system, is buying the dominant player in hand hygiene to go after the B2B market, and is betting that consumers will pay a premium for failure prevention in their own homes.
It's a pivot. They're moving from being a volume-driven commodity seller to a value-driven wellness company. They know they can't win a price war against dollar stores and private labels forever.
So they're trying to exit the war by moving upmarket.
Upscaling the mundane in a way. And it raises a fascinating question about the economy as a whole. We keep asking if the consumer is strong or weak. Maybe that's the wrong binary. The consumer is selective.
Selective based on risk.
I think so. Based on what they can control. You can't control inflation, you can't control the job market, but you can control whether your trash bag leaks or your kid sneezes from dust.
And that's the bet.
Clorox is betting people will pay to control the variables inside their own four walls, even if it means cutting back somewhere else.
That's a powerful thought. The home as the last fortress of certainty.
And Clorox wants to be the gatekeeper.
Well, next time you're in the cleaning aisle, look past the bright labels. So you're looking at a battlefield of price pack architecture, digital logistics, and a whole lot of psychological warfare. It's a lot more interesting than just bleach.
It always is.
We'll leave it there for this deep dive. Thanks for listening, and we will catch you on the next one.